This week we're going to look at some of the developments in central bank policy. Last night we had Janet Yellen talking about interest rates and also the stubbornly low rates of inflation. She did actually acknowledge in the testimony to Congress that low inflation could eventually raise questions around the trajectory of the FOMC rate hikes. And or she also noted that there could be something else going on there in reference to as to why inflation was remaining below 2%. So what we're having a look at in this chart here is the neutral Fed funds rate in real terms, and that's the gold line. And we're comparing that to the actual real Fed funds rate. And we can see the gold line is estimated presently to be somewhere around about 0%. Now, it's a very difficult thing to measure. This is from the San Francisco Fed's John Williams. So that's currently estimated to be around about 0. The real Fed funds rate, as we've seen over the past few years, has generally been in the vicinity of, say, -2, -1.5, and we've seen a recent uptick in that as inflation has declined and as the Fed has been tightening. So the real Fed funds rate is now sitting somewhere around about -0.5, -0.75 in that sort of range. Now, also on the chart, we're showing the history of that relationship between actual real Fed funds rate and also the neutral rate. And we can see here going back to the mid 1980s. So periods where the red line is above the gold is essentially periods of tight policy. The real Fed funds rate being above neutral. And that's generally been associated with the yield curve, which is the top line on the right-hand scale. The yield curve is measured by the 10s minus 2s going inverse or very close to inverse. So certainly the case in the late 80s, as you can see there, followed by a recession, the shaded period. Then during the mid-90s, in fact, Fed funds went above neutral probably around about the mid-1990s, and we didn't have a curve inversion, or it became very flat, but it didn't invert actually until much later on. So that's the relationship there. Then we had a recession obviously in the early 2000s, and then once again in 06, 07, where the real Fed funds rate went above neutral, tight policy, and subsequent recession. So putting all that into the context of the current environment, this gap has been closing. What it suggests now is there's probably only 50, 75 basis points between the current real Fed funds rate and what is perceived to be neutral. And hence some of the concerns around, I guess, the FOMC current trajectory for interest rates, which is represented by the green line in real terms. So the Fed has rates rising eventually to something like 3%, if we believe the dot plots that they put out. And that would have policy basically moving above neutral within 12 months, which, as we've just seen, has typically been associated with flat to inverted curves, and also the prospect of recession and probably more volatile equity markets. So the fact that Janet Yellen is making, or is at least acknowledging the low levels of inflation and perhaps the questions around their projected path of interest rates, that's why that is quite an important development, we feel, overnight. The market at the moment is the purple line, and it's really only pricing in Fed funds getting to what is currently estimated to be neutral over about another 2-year period. It really is to the end of 2019 before the market is really thinking about policy getting to neutral. So that would give markets plenty of time to continue to focus on other factors other than Fed having a tight policy setting. Yes, the discussion as to when the central bank or the Fed should reach neutral policy is generally centers around some sort of concept of the output gap, and now that's represented by the purple bars here, and this is from the Fed estimates of what the real GDP output gap is. And the two lines there are the ones that we just discussed a little bit earlier on, the actual real Fed funds rate and what is perceived to be the neutral real Fed funds rate. So as we've seen in the past, neutrality or tight policy has generally occurred around the time when the economy has breached its capacity, if you like, operating in excess of capacity back here in the late 80s. Once again, eventually in the latter part of the 1990s, and this went on for quite some time. And then again, the economy was operating above capacity through 06, 07. And at the moment, after having an output gap of about 6% back in 2009, that has very steadily narrowed over the last 7 or 8 years. Still estimated to be a minor output gap, but the expectation is that that could well and truly have been removed over the next 12 to 18 months, and that's the sort of time horizon over which the policy could actually move to a neutral, or in fact even slightly above neutral, a tight position. Now, this is the area of debate at the moment. The evidence seems to be that certainly on wages, that they are not responding in the way that might represent an economy growing at or near or even above capacity. So these are the questions that the Fed is currently asking. The market certainly doesn't believe that capacity will be reached anytime soon, causing upward pressure on inflation. Certainly, when we're discussing interest rates, the other news overnight was the move by the Bank of Canada to lift rates up to 0.75 from 0.5. As you can see here in the chart, they've had extremely low rates for the past 2 or so years. So this is an interesting move, and it's raised questions as to whether Australia might be one of the other central banks to follow suit. As we can sort of broadly make out here on this chart, the Canadian rate is in blue, the Australian cash rate is in red. So they've generally followed each other, although quite a divergence. Australia tightened more aggressively than Canada during the post GFC recovery. Australia, the lift in the terms of trade and the stimulus out of China probably creating an environment of or need for tighter rates, and then the subsequent unraveling of the Chinese investment and commodity prices having a larger impact on Australian cash rates over that period, whereas Canadian cash rates stayed a lot lower in the first place. So this move doesn't necessarily mean that Australia is about to follow suit, but as we'll see when we look at our own RBA indicator, and we've highlighted this on previous occasions, and this is purely looking at a range of indicators that have typically been associated with either policy tightening or easing, and we can see that the red line, that's a composite index of the underlying indicators, and that's pushed up to its highest level really since 2010. And most of the move has occurred just in the last 2 to 3 months, and that's largely been down to the strength in employment as represented by the ABS series, and also declining unemployment. For some time, we've had the other components, NAB business conditions and cap use, at levels associated with tightening policy in the past. So a lot of those indicators have switched on, are on at the moment. The one indicator that is not on and continues to sort of support more of an easing bias, of course, is implied inflation expectations, and which are continuing to run at somewhere around about 1.8. So they're below the lower end of the band, and clearly that's having a much more significant weighting in the decision making and indeed market expectations at the moment. But I think this is worth focusing on. The activity type indicators are all doing reasonably well. Certainly are not suggesting any room for an ease anytime soon, and in fact they're beginning to argue that the bias could well also begin to turn towards the tightening side. Thank you.